The Momentum IF Africa ex-South Africa Equity Fund was launched in 2007. It aims to exploit opportunities in the still under-invested markets on the African continent. The fund invests in listed equity securities on recognized stock exchanges across the continent, but excluding South Africa. Fungai Tarira, Head of Africa Investments at Momentum Asset Management, joins us in studio for more. Welcome, Fungai.
Thank you.
A very exciting area, and I think it's been exciting for several years, but to a large extent still the preserve of institutional investors because of the lack of liquidity.
There are a number of characteristics that you find in African markets that many regulators and indeed investors who are on the retail end of the pool are not comfortable with, and chief of which is exactly as you point out, the issues around liquidity. Having said that, however, a lot of the opportunities that people are actually looking to exploit in these markets are things that are taking place over the longer term. So if you're looking to play growth in population, the growth in the middle class, it's not something that's going to turn out over the next quarter or over the next 6 months. So at least investors have to sort of go in there with the right frame of mind to fully take advantage of the opportunity.
But having said that, my impression though, liquidity is a problem, but becoming less so. In other words, as time progresses, liquidity conditions are actually improving rather than static or deterioration.
If I look back maybe over the last, let's take it 5 years, I think we've seen two distinct sort of periods. Coming into the crisis, we've seen a lot of new companies coming through to list. We've seen a lot more participants coming onto the market. So that time I think was characterized by far much more liquidity than we'd ever seen across many of these African markets. Post the crisis, a fair amount of foreign investors who are participating in African markets are Western based, and they retreated back to their home markets. We've seen them return to some, but not to all markets. So you'll find that some of the markets have actually had increased liquidity or it has come back, whereas others have actually gone drier than they were pre-2007.
One of the point, and I think relates to the liquidity issue, is that this market is still underexplored in spite of all the hype. And have you seen that shifting too? And is it all about getting in there as soon as possible? It reminds one of the China story, getting there even though you know this is a very long-term story, but you need to get your toe in the door.
One of the things we've seen in the last couple of years is the influx of frontier funds, people doing coverage of frontier markets, and indeed many more African markets and countries. So the discovery is starting to come through, but again, if you're to compare the levels of coverage, the levels of understanding that international investors will have of these markets to, say, South Africa, you'll find that there's a very big difference and there's still a lot more to come through with that. What that does mean as well is that you get far fewer buyers and sellers participating on those markets, and price discovery doesn't occur as easily as it does in a market like South Africa or New York or wherever else.
No, my sense is that to try and actually establish the difference between value and price is where the skill of the manager needs to be to come in. But again, it's where Africa has been and where it's getting to, I think, is the critical point. The choice is widening, the liquidity is widening, but also it's not one of those cells that is red hot. In other words, that was the best performer of last year. You start to get a sense that Africa is a place one should be invested in, but it's not red hot, because in fact in the last 2-3 years you've actually had a bit of a drawdown, in other words a withdrawal of investors from the market, which is strange in that sense. But the one thing that you pick up is that the change that's taking place is that the growth has become a lot more resilient. And one of the reasons for that, it's become a lot more multi-sectoral than in the past, where if, like the Zambian economy, if the copper price is up, it's okay. If it's down, then it's dead on arrival.
So the economy is diversifying. You're also seeing greater political stability and the institutions being more established, more sound.
100%. And I think exactly as you point out, it's something that takes place over time. It's not something that happens in very short periods. You know, as you rightly point out, over the last 3 years, 2 years, or indeed 1 year, the performance numbers of African markets versus other markets out there have actually been quite poor. If we If we take the numbers over 10 years, African markets are up something like 3.6 times versus the US European markets which are up 1.3, 1.4 times.
Yes.
So it is a long-term story, and it is something people have to be patient with to get the full benefit.
On that long term, it's important to appreciate why that long term has happened, because the actual investment timelines have always been quite short, and that's because the constitutional arrangements have been very, very dodgy. We know that this, this tyrant is being overthrown by another tyrant, and that kind of, not even every 5 years. And so when you've got that situation and you've got to bribe your way to be in business, and then the person you bribed gets thrown out, and anyway, your investment timeline is very short. You make hay while the sun shines. But now, as you're getting increasingly constitutional arrangements, the democratization is important. The timelines just shoot out.
Yes.
In other words, your investment horizons can start becoming very long term, and that's why I think you're getting a platform which is actually quite positive from an investment horizon and investment performance point of view.
Funga, you might want to respond to that, Funga, but what was the impact? Did you see an impact of the African Spring on the investment performances in the various regions where you are invested?
Oh, 100%. Looking at Egypt, prime example, when the Arab Spring actually hit, the market was down some 54–55% in US dollar terms in a very short space of time, coupled with the fact that for about 2.5 months, the market was actually closed for trade as they went through the difficulties they had at that time. Following on from there, as they climb out of the spring and set themselves on the democratic path, exactly what you're talking about, we've seen some of those stocks rebound quite significantly, gaining ground back to the levels that they'd seen maybe 12 or 15 months ago. So that there was tangible impact. The same, but not to the same magnitude, could have been seen in Tunisia as well. Libya's stock exchange is not really open to foreign investors at this stage, so we haven't really been monitoring that situation. But understandably, every time you have, I think, an event of that magnitude and of that gravity, you will have impact on the markets.
So it illustrates again the importance of diversification. You wouldn't want to be exposed to just one country or one region or one set of political circumstances.
100%. Twice we've seen that in the funds that we have. The first time around was the Nigerian banking crisis, where fortunately we didn't have as large an exposure to the market.
So you did that. You did have some exposure.
We did not. We did not, fortunately. And then the second time around is the Arab Spring as well, where, if we had gone up to the 40–50% levels of exposure to that market, you'd obviously have felt that quite badly in the performance numbers.
How do you select for country risk and political risk? Or do you have certain filters and screens that would highlight possible risks for you?
One of the things we do as Momentum Asset Management is we spend a lot of time in country, speaking to people on the ground, whether it's stockbrokers who provide trading information, whether it's researchers, policymakers, testing the temperature for ourselves and trying to understand what exactly is going on. Once you understand those things, I think you can pick up on a trend on what is actually happening in that country and whether it is actually going to be good or bad. We can never call election results, we don't try to, but the point is, can you understand if the trend is positive, neutral or negative, and that's how you then make your decision.
When one looks at political risk, it's actually quite an interesting shift that's taking place, is that in the developed world, the indebted are politically more powerful than the sovereign investor. And so the solution to debt levels that are going exponential is basically will be to appropriate value from the sovereign investor. And that is huge political risk. I would not be wanting to invest in France under any circumstances, because I'm seen as a pot to plunder as an investor. Whereas in Africa, you don't have the debt levels, so you don't have that dynamic, because Africa is not credit worthy, or it hasn't been, and that's been their huge advantage. So there aren't the debt levels in the households or the businesses, etc. There they actually give you investment protection, roll out the red carpet if you want to invest, because they know that's part of the solution. And you then say, well, what do we mean by political risk? If you're looking at it in a traditional sense, it might not be what you might not be the most profitable, but you need to look at it from an investment sense, and it may be that Zambia is lower political risk than France.
And agreed, there's no goodwill from before to abuse.
No,
quite a number of these countries. So, if anything, they're trying to prove that they are worthy investment destinations, and that means that they make all the changes that can actually welcome investors.
It's like the LIBOR scandal, right? In South Africa, we've got JIBAR. The potential for manipulating that is much higher because there's fewer participants, and we try harder, I think, to keep it cleaner as a consequence.
Perhaps that relates to my next question, is on the kinds of sectors to which you have an exposure. The biggest there, the financial sector. So as these institutions become established, as you said, there aren't legacy issues there. But is it that simple to select a bank that isn't going to crash, or somehow the shareholder arrangements aren't murky?
It's always a difficult thing to try and pick a share that's going to do well for you in the portfolio. But be that as it may, the weights that you then see in our portfolio are actually as a result of the bottom-up exercise that we've actually carried out to select the different stocks. Why I say that is because we do not sit there and then target, for argument's sake, banks and insurance and financial companies and say we want to have a certain weight, because a bank in Nigeria and a bank in Kenya are operating in two very different environments. The monetary policy is different, the non-performing loan experience is different, and to that extent I might be overly in love with Nigerian banks and not really touching Kenyan banks. That will affect the total weighting that you actually see on this. So it's the bottom-up work that we actually do that then helps us select those institutions. And we're looking for banks that are in growing markets, that are growing market share, that are managing to control their non-performing loans and improve on their risk management characteristics, and are obviously trading at a reasonable, if not a cheap price.
But I think the problem that you can have with this is that firstly there's each country has its own fundamentals, as you point out, but the listings on the stock market don't always reflect the economy either, and so you're almost forced into what is listed, and that is a hassle.
Funga, we're leaving it there. It was a delight speaking to you. Thank you, and hope we get another chance to hear more about your decisions. That's Funga Tarira, Head of African Investments at Momentum Asset Management.